Understanding VAT is essential for running a successful business in the UK. In this video, I'm going to cover everything from what VAT is to when and why you need to register for VAT, what happens after you've registered, and why you might choose to register voluntarily even if you haven't passed the thresholds. My name's Rayhan Mogul. I'm a chartered accountant and the founder of Sidekick Accounting. By the end of this video, you'll have a solid understanding of VAT and what you need to do about it. Let's start with the basics. What is VAT? VAT stands for Value Added Tax, and it's a tax that businesses collect on behalf of the government. If you sell goods or services that are VATable, you add VAT onto your sales price and you collect it from your customers. On the other side, you pay VAT on the things that you buy for your business. Then you see how much you receive from your customers, how much you've paid out to your suppliers, and hand over the difference to HMRC. It's a really simple example. Imagine you're selling a service for £100 and the VAT rate is 20%. You'll charge £120 to your client. £100 of that is revenue to your business. £20 of that is VAT that you're putting aside. Now let's say you've also made some purchases for £50 at 20% VAT. You spend £40 and £10 of that money is VAT that you can offset against what you've collected. In this example, you deduct the £10 from the £20 and you pay the remaining £10 over to HMRC. So in short, you collect VAT from your customers, you pay it out to your suppliers, and you pay any difference to HMRC. The next question is when and why do you need to register for VAT? You need to register for VAT if your annual taxable turnover, which is the revenue you make before expenses, exceeds the VAT registration threshold, which is currently £90,000. Not all income you make will count towards the £90,000 registration threshold. Taxable turnover includes the value of any goods and services you sell that would be standard rated, reduced rate, or zero rated if your business was VAT registered. However, income that's exempt from VAT or outside of the scope of UK VAT does not count towards that threshold. This includes sources like income from financial services, income on rental properties, or income made by selling to customers outside of the UK and outside of the scope of UK VAT. Now, if your turnover is below this threshold, you don't have to register, but you can choose to voluntarily register. One of the key benefits of doing this is your ability to reclaim VAT on things that you've purchased. For example, if you're frequently buying stock or other goods that include VAT, you could potentially significantly reduce your cost base by being able to reclaim that VAT. But on the flip side, by registering, you also need to charge VAT out to your clients, and that might make your product or service more expensive than it was before for your clients, especially if they're not businesses and VAT registered. This could impact the competitiveness of your pricing in the market and have an even bigger impact on your business. Voluntary registration can also be a good way to future-proof your business, especially if you're thinking you will cross that threshold in the near future. Registering now will mean you don't have that rush when it comes to the VAT registration threshold being reached, but it also means you can start to build out the systems and processes that you need in order to be prepared to file your VAT. When looking at whether you need to register for VAT, you need to check your turnover on a rolling 12-month basis. So at the end of each month, check your turnover for the last 12 months and check if it's gone over £90,000. If it has, then you have 30 days to inform HMRC, and your VAT registration date would usually be the first of the following month. So what happens when you're registered for VAT? Well, firstly, you'll need to add VAT to your sales price and issue VAT invoices to your clients. You'll also need to file VAT returns with HMRC, which I'll go into detail a little bit later in this video. HMRC will give you a VAT number and you have to display this on your invoices. You'll also need to keep good records of any sales that you've made or expenses that you spent money on in the form of receipts and invoices. And this is where good bookkeeping becomes so important. If you can't produce a VAT receipt or invoice if HMRC asks, that VAT is no longer reclaimable for you, and you could find yourself in a situation where HMRC want you to pay all of that money back many years later. Next, let's look at the right VAT scheme for you, because there are multiple VAT schemes in the UK. The right one depends on how your business operates. The first and most common is the standard VAT accounting scheme. This is where you will charge 20% VAT on your sales, you will reclaim VAT on your purchases, and you'll file a VAT return with HMRC every quarter. That VAT return will tell HMRC how much you've collected from your customers, how much you paid out to your suppliers, and therefore how much you either need to pay to them or they need to pay back to you. Second is the flat rate scheme. This is designed to be a very simple approach to VAT for businesses doing less than £150,000 in turnover. Under this scheme, you don't reclaim VAT on purchases. Instead, you apply a fixed percentage to your turnover, which you then pay over to HMRC. For a marketing agency, that percentage is currently 11%. The flat rate percentage changes depending on your industry, so make sure you check the HMRC guidance to find out what percentage applies to you. Third is the annual accounting scheme. Under this scheme, you make part payments to HMRC quarterly based on your previous year's return. You then submit one annual VAT return at the end of the year. This scheme can help with cash flow, and you only need to submit one VAT return a year, which reduces the amount of admin required from you. And fourth is the cash accounting scheme. Under this scheme, you only pay VAT when you receive the cash from your client. This is different to the standard accounting scheme where you'll pay VAT on invoices even if they've not been paid. The cash scheme is typically great for businesses that have cash flow issues or have longer payment terms like marketing agencies. Choosing the right scheme can save you a ton of money, so make sure you get some advice from an accountant about what the right solution is for you. Next up, let's look at what you need to do to file your VAT return. Most businesses will file their VAT return quarterly, but like I just mentioned, there's also an annual scheme, which would mean you only do this once a year. Typically, each return covers a 3-month period, and you need to submit it to HMRC 1 month and 7 days after the end of that quarter. So if your quarter ends in June, you have until the 7th of August to file your return. The VAT return will show the VAT you charged your clients, which is called output tax, the VAT that you're reclaiming from your suppliers, which is input tax, and the difference, which is the amount due to be paid or to be reclaimed. To submit your VAT return, you need to use Making Tax Digital, which is a system HMRC have developed that links in with their accounting software and lets you digitally file VAT returns. Under Making Tax Digital, businesses have to use HMRC compliant software in order to file those returns. This means spreadsheets and paper-based accounting are no longer acceptable. Here's 3 steps to make sure you're compliant with Making Tax Digital. Firstly, have the right accounting software in place. Something like Xero is great and links straight in with HMRC. Second, if you're VAT registered, you'll need to sign up for Making Tax Digital with HMRC. Third, once you're signed up, your accounting software will start to calculate your VAT liability based on the records that you keep and make it easy for you to file it online. Your accounts would be clean and accurate. You'll have your receipts and invoices stored digitally, which helps you stay organized and compliant. For VAT, chosen the right scheme, set up your software, and filed your return. The final step is, how do you actually pay HMRC and when? On the same day as the return, so 1 month and 7 days after the quarter ends. There's a few ways you can pay your VAT bill. You can set up a direct debit, you can make a bank transfer, or you can use online banking. When you register, HMRC will tell you all of the options available to you to make payment, so make sure you take note of that and choose the one that's most appropriate for you. You set up a reminder in your calendar for that filing and payment deadline, because if you miss it, you'll be incurring penalties and penalty points. To wrap that up, VAT can seem complicated at first, but once you're registered and you have the right systems in place, it's actually quite straightforward. You simply collect VAT from your customers at the correct rate, pay it out to your suppliers, and then calculate the difference each quarter or year and pay that over to HMRC. Good record keeping and cash management will make VAT something that just happens in the background of your business. If you found this video helpful, give it a thumbs up and subscribe to my channel for more tax saving content.